Imagine a global packaging giant. I mean, one that touches almost everything you use daily. Your food, your medicine. Now, picture that same company standing right at a crossroads. They've just pulled off this massive merger, potentially game-changing. But at the same time, they're facing huge pressure, new sustainability demands, economic uncertainty. It's a lot. So the big question we're tackling today is, can a company with Amcor's sheer scale truly innovate, unlock real shareholder value? Or is that massive size actually becoming its biggest liability now? We're going to peel back the layers on exactly that. Welcome to the deep dive. Today, we're cutting through the noise on Amcor Tillich, that's NYSE ticker AMCR, a global leader in responsible packaging. Our mission, as always, is to pull out the most important insights from, well, a whole stack of sources we've reviewed. We want to give you a clear picture of where Amcor stands right now. And we're anchoring this analysis to June 27, 2025, when their shares closed at $9.19. This deep dive is structured to, get you up to speed quickly, thoroughly give you those aha moments without just drowning you in data. And just a quick reminder for those interested, if you want priority deep dives on specific tickers, check out our Stock Analytics AI membership. It's just $4.99 a month. Members get exclusive early access, and we're planning to cover all the S&P 500 stocks in the coming months. Or if you just want one specific deep dive, you can always request it using Super Thanks. Okay, let's get into it. Let's unpack Amcor. We'll start with the basics, its core business, take a look at its leadership, and then really dig into the financial health. Chapter 1, Business Analysis. So at its heart, Amcor designs, develops, and sells responsible packaging solutions. And they sell these to some of the world's biggest brands. Think about essentials food, beverages, healthcare, personal care. Those are their core sectors, what they call defensive, non-discretionary sectors, which, provides a pretty resilient foundation for the business. They operate mainly through two big segments. Flexibles, that's the larger one, brought in about $10.3 billion in revenue in fiscal 24. And then there's rigid packaging, which added around $3.3 billion.
Right, and that strategic focus on flexibles,
Yeah.
making up roughly 75% of their revenue, that's really interesting. It shows deep expertise, sure, but it also meant, higher exposure to risks in that specific market,
Mm.
like volatility in plastic resin prices, for instance. And understanding that context is absolutely crucial for grasping why they did that huge transformative merger with Berry Global that just closed this past April. Acquiring Berry Global, which is a major player in rigid containers, wasn't just a small move. It was a deliberate, massive strategic pivot for Amcor. The whole goal, create a more diversified, more resilient revenue base. And, importantly, reduce their dependence on just one segment, unlock some key cross-selling opportunities too.
And it's not just like plain vanilla packaging, right? Amcor has these branded product lines, healthcare for medical stuff, Prime Seal and Dairy Seal for food. But what about this Amprima portfolio? They're recycle-ready solutions. Is that just, marketing speak, greenwashing, or is it a real differentiator in what looks like a really competitive market?
That's a really good question. And no, it's definitely not just greenwashing. Alpramide is more than just a product line. It's Amcor's strategic lever. They're basically using it to turn regulatory pressure, which is huge, into a competitive advantage. They're essentially letting their B2B customers think big consumer brands outsource their sustainability R&D and compliance headaches to Amcor. So what could be a massive cost for those brands becomes a value-added service from Amcor. For, say, a major pharmaceutical company or a global food brand, getting recycle-ready packaging from Amcor is a critical part of their value proposition to their customers. Unless Amcor sells sustainability as a feature, and that creates these incredibly sticky long-term relationships. That's a powerful business model, very resilient.
Yeah, you can see that. And Amcor's market position, I mean, their sheer scale is just undeniable. They're a global leader, operating from 212 locations across 40 countries, 41,000 employees. And get this, they produce something like 64 billion units of packaging every single year.
That huge operational footprint brings really significant advantages, especially economies of scale. Look, as one of the world's biggest buyers of raw materials, plastic resins, aluminum, things like that, Amcor has serious negotiating power. That helps them manage costs way more effectively than smaller competitors can. Plus, their global network means they can serve those big multinational clients seamlessly across borders. That's incredibly difficult and expensive for anyone new to try and replicate.
Okay, so this global giant churning out 64 billion units a year, is that massive scale purely a blessing, or could it be a bit of an anchor sometimes? What's their main pitch to customers?
Well, that's a key distinction. Amcor really acts more like a strategic partner than just a supplier. Their value proposition seems to rest on three pillars. One, differentiated solutions. Two, expertise across a whole range of materials. And three, leadership and sustainability. So for a big consumer packaged goods brand, Amcor isn't just providing the container. They're also offering critical R&D support, deep knowledge of complex international regulations, and crucially, a direct path to meeting the customer's own corporate sustainability targets. It's this whole integrated service model. And like I said, that fosters these really sticky long-term relationships, hard to break away from.
Okay, that makes sense. So if that's their model, what's going on in the wider industry? Let's shift to industry analysis.
Yeah, the packaging industry definitely seems to be at an inflection point right now in 2025. The biggest trend easily is sustainability. Consumers, regulators, everyone's demanding packaging that's recyclable, reusable, maybe compostable. We're even seeing this paperization shift moving away from plastic where it makes sense. Then there's the rise of smart packaging using AI, QR codes, RFID for tracking and engagement. And of course, you've got the relentless growth of e-commerce, which keeps driving demand for packaging that's both durable and lightweight.
And this is exactly where that tension between opportunity and threat becomes so central to the investment case for Amcor. So while the overall U.S. packaging industry might only grow modestly, maybe 1.4% to 2.0% CAGR, the global sustainable packaging part of the market, that's forecast to grow at over 6% CAGR. Huge difference. Now, this creates a massive opportunity if Amcor can really lead that transition. But there's a flip side. If the market shifts too quickly away from their core materials like certain plastics, their enormous scale could suddenly become a liability. Think about the huge capital spending needed to retool all those facilities. It's a really delicate balance they have to strike.
And competition. It sounds like a tough market, but maybe consolidating a bit. We're talking about players like International Paper, Ball Corporation, Packaging Corporation of America, Sunoco Products, and Berry Global, as we keep mentioning, used to be a rival. Now they're part of Amcor. When you look at the stats for these companies side by side, what immediately jumps out about Amcor's valuation right now?
Well, comparing Amcor to its peers, you see a really stark contrast. Amcor trades at a notable valuation discount, and it boasts a much higher dividend yield. For instance, International Paper, ticker IP, trades at nearly 40 times trailing earnings. Ball Corporation, BIL, is in the mid-30s. Amcor, around 16.4 times earnings. That's a big gap. And this isn't just a number, right? It's the market basically telegraphing some deep skepticism about Amcor's future, despite its clear market leadership. The real question for an investor here is, does that skepticism represent an undervalued opportunity, or is it highlighting a genuine red flag? And that's what we're trying to figure out.
Regulations are getting tighter too. You mentioned sustainability pressure, especially in Europe, right? Things like the PPWR, that's the packaging and packaging waste regulation, and these EPR laws, extended producer responsibility.
Exactly. EPR laws essentially make producers financially responsible for dealing with their packaging at the end of its life. And while these regulations definitely bring compliance challenges, extra costs, they also act as pretty powerful barriers to entry for smaller companies. It's expensive to comply. So paradoxically, for a leader like Amcor, which is already investing heavily in sustainable solutions and has the scale to manage compliance, these regulations can actually strengthen its competitive position. They kind of force the entire market towards the very technologies where Amcor wants to be the leader.
So pulling it all together, what really makes up Amcor's competitive advantage, their moat, so to speak, against all these pressures?
It's really multifaceted. First, just the high capital intensity of the industry itself. It costs a fortune to build these plants, which deters new players. Then, their huge economies of scale, especially in buying raw materials. Remember, raw materials are over 60% of their cost of goods sold. That gives them a massive cost advantage. Third, those customer relationships are incredibly sticky. Switching costs are high. Imagine you're a huge beverage company. Changing packaging suppliers midstream is a nightmare. And finally, their intellectual property. Over 1,200 active patents. Plus, they're investing over $100 million annually in R&D. That really sets them apart. You combine all that scale, cost, switching cost, IP, and you get a pretty formidable, durable, competitive edge.
Chapter 2, Management Evaluation. Okay, a big thing here is the recent change at the top. Ron D'Elia stepped down as CEO, and Peter Konieczny took over. He was the chief commercial officer before this, right? Early 2024. Any leadership change brings some uncertainty, but picking the CCO, that seems deliberate. What does that signal, do you think?
I think it signals a very clear priority. Smooth commercial integration after the Berry merger. That's got to be job one. Retaining those key Berry customers, realizing the promised revenue synergies, that's absolutely paramount right now. And having a leader with deep commercial experience makes perfect sense for that. We've also seen this management team act decisively before. Remember the structural cost cuts, the 5% workforce reduction back in 2023-2024. That was to protect margins during a slowdown. And let's face it, pulling off that incredibly complex all-stock Berry global merger in April 2025. That says a lot about their ability to actually execute on major strategic moves.
And how about communication,
Right.
transparency? They seem pretty open, right? Regular earnings calls, detailed investor decks. They talk about challenges like volume softness, destocking.
Yeah, based on the sources, they seem quite transparent. They don't shy away from discussing the headwinds. And we didn't find any major red flags concerning their ethical reputation either.
Okay, let's switch gears to capital allocation because ultimately, how management spends the company's money is a huge driver of long-term value. And the undisputed centerpiece of Amcor's recent strategy has to be that Berry Global merger. All stock deal closed April 30th, 2025.
Absolutely. And the main justification, the number they keep highlighting, is that massive $650 million in annual pre-tax synergies they expect by the end of year 3 post-merger. I mean, this really is a bet the company kind of move. And while it promises significant diversification, scale benefits, it also introduces substantial integration risk. That's undeniable. And it adds a chunk of debt, too. Beyond this huge deal, sure, they do make smaller targeted organic investments, expanding in emerging markets, buying new equipment. They also have Amcor Ventures doing small seed investments. But honestly, the Berry merger just completely dwarfs everything else in terms of scale and strategic importance right now.
And what about returning capital to shareholders? They've bought back shares before I see $500 million back in 2019, about $70 million in FY24. But the dividend seems like a bigger focus for them.
It really does. Amcor has a strong track record here. They've increased their dividend for 5 consecutive years now. And importantly, right after the Berry merger closed, they actually raised the quarterly dividend again to 0.1275 per share. At that $9.19 share price we're using as our anchor date, that translates to a pretty compelling dividend yield of about 5.5%. That consistent growth, even through tough times in major M&A, is a powerful signal. Suggests management is confident in the company's cash generation and committed to returning cash to shareholders.
Okay, now a critical metric for judging management efficiency. Return on invested capital, ROIC, how well do they deploy the capital they have? Amcor's ROIC is stated as 6.84%, or maybe 8.6% by some calculations.
Right. The exact figure can vary slightly. But what's potentially more concerning here is the historical trend. After their last big acquisition, Bemis, back in 2019, Amcor's ROIC actually went down. It declined by a significant 4.9 percentage points or 490 basis points. That decline is, frankly, a major red flag. It suggests that the last big M&A deal didn't necessarily lead to more efficient profits relative to the capital invested. So this raises an absolutely critical question for the even larger Berry merger. Has management learned from that Bemis integration experience? Watching the trajectory of ROIC over the next, say, 4 to 6 quarters, it's not just important, it's arguably the single most critical metric for judging whether this massive strategic bet is actually paying off.
Chapter 3, Financial Analysis. Okay, let's dive into the numbers. As of our analysis date, June 27, 2025, Amcor's market cap is sitting around $21.0 billion. How about revenue trends? Looking back 5 years, fiscal 2020 to 2024, revenue went from about $12.5 billion up to a peak of nearly $14.7 billion in FY23. But then it dipped back down to $13.6 billion in FY24. That was due to customer destocking, right? So over 5 years, that only works out to a modest 2% compound annual growth rate, CAGRD.
Exactly. And that low single-digit organic growth really underscores the why behind the Berry global merger. The company clearly needed a new engine for growth, something it was struggling to find organically, especially in its more mature markets.
And profit margins, what do the trailing 12 months look like? Okay, gross margin around 20.0%, operating margin about 10.1%, net margin near 6.0%. Seems pretty typical for a big manufacturer like this. Relatively stable, but always feeling that pressure from raw material costs, I imagine.
Yes, that's a constant factor.
Maybe the most impressive part of Amcor's financial picture, though, is its free cash flow generation, FCF. Looks pretty strong. It recovered well to $868 million in fiscal 2024. And management's guiding for $900 million to maybe $1.0 billion for fiscal 2025.
Yeah, that powerful, resilient cash generation is absolutely key. It provides a significant margin of safety for the business. And ultimately, it's the foundation that supports that generous dividend policy we talked about. And FCF is the lifeblood it funds, the dividends, the buybacks, and importantly, the debt reduction they need to do.
Okay. Shifting to financial stability, Amcor seems reliably profitable. Net income has been consistently positive, anywhere from $464 million up to over $1 billion in the last 5 years. But, and this seems like a big but, the debt-to-equity ratio, it's up at 2.41. That signals a pretty substantial amount of debt, mostly from all the M&A, right?
That's exactly right. And that high debt significantly increases financial risk, no question about it. It makes the company more vulnerable to economic downturns. And crucially, in today's environment, it makes them very sensitive to rising interest rates, which directly increase the cost of servicing all that debt. This high leverage is, without a doubt, a primary pillar of the bear case against the stock. It's a key risk potential investors just have to get comfortable with.
On the flip side, though, their current ratio is 1.70. That suggests healthy short-term liquidity, doesn't it? They have enough liquid assets to cover immediate bills.
Yes, that's correct. Short term, they look okay liquidity-wise.
And back to that dividend again. 5 straight years of increases, that attractive 5.5% yield. But I see the payout ratio based on GAAP net income is quite high, maybe 91%. That might make some people nervous about sustainability. Is it sustainable?
This is a really crucial distinction, especially for capital-intensive companies like Amcor. While that GAAP payout ratio looks high, maybe uncomfortably so, free cash flow is actually a much more accurate measure of a company's real ability to pay dividends. And for Amcor, their free cash flow per share is significantly higher than their earnings per share, EPS. So what that means is the dividend is actually much more comfortably covered by the actual cash the business generates. This makes it likely much safer than it first appears just looking at the GAAP ratio, and that's a cornerstone of the bull case, particularly for income-focused investors.
Okay, finally for this section, let's touch on valuation analysis. Amcor's trailing 12-month PE ratio, the TTM PE, is about 16.4, and that's near its one-year low. Compared to peers like International Paper at almost 40, Ballcore over 32, even Packaging Corp of America around 19.5, Amcor looks significantly cheaper.
Yes, that substantial discount is very apparent, and it clearly suggests market pessimism. Right.
It's likely driven by those concerns we've discussed: the high debt, the relatively slow organic growth pre-merger, and the considerable execution risk tied to integrating Berry. However, for a value investor, this is exactly the kind of situation that could signal an opportunity if that market pessimism is overdone compared to the underlying value and future potential.
And to get a handle on that underlying or intrinsic value, we often use a discounted cash flow analysis, a DCF model. Basically, valuing the business based on its expected future cash flows, discounted back to today.
Right. And our educational DCF model, based on the data, suggests an estimated intrinsic value range for Amcor of somewhere between, say, $10.50 and $12.50 per share. Now, there are always key assumptions in any DCF model. The two most critical here are the discount rate, the weighted average cost of capital, or WACC, which we've estimated in the range of 8.5% to 9.5%, adjusted upwards a bit to account for Amcor's higher leverage post-merger. And the second is the perpetual growth rate assumption, how fast we assume cash flows grow forever after the forecast period. We used a conservative range of 2.0% to 2.5%, basically in line with the expected long-term growth of the broader economy and the packaging industry itself.
Okay, we've laid out Amcor's foundations, the business, management, financials. Now let's turn to how the market is actually reacting to all this. What's the mood on Wall Street? What are the key indicators telling us? This is where it gets really interesting as we move into part 2, digging into market sentiment and risk. Chapter 4, Market Sentiment. So what are the professional analysts saying? Generally, it looks like Wall Street has a positive view. The consensus rating is often cited as moderate buy or even strong buy, and the average 12-month price target seems to be hovering around $11.30 an ounce to $11.80, compared to the $9.19 share price. That suggests potential upside of, 25% to 28%?
Exactly. So that indicates that, on balance, the analyst community thinks the market is currently undervaluing Amcor. They seem to be seeing significant potential, probably from those merger synergies kicking in, and also valuing that strong dividend yield.
And recent news flow has obviously been dominated by the Berry Global merger closing in April 2025, the CEO transition we discussed in their quarterly earnings reports. What's the general tone in the media about the company right now?
I describe the general media tone as cautiously optimistic. The headlines often lead with the transformative potential of the merger. But that optimism is usually tempered by discussion of the challenges, the persistent volume softness they faced, the broader macroeconomic headwinds. It really paints a picture of a company at a pivotal moment, and the media coverage seems to reflect that kind of balancing act.
Okay, looking at specific market indicators, we saw a note about a significant one-day spike in short sale volume hitting 21% on that particular day. Does that mean there's a big bearish bet building against Amcor?
Well, it certainly points to a bearish contingent out there. Yes, people betting the price will go down. However, another data point mentioned is the low days to cover ratio, around 1.3 days. That suggests there's probably less risk of a dramatic short squeeze. It wouldn't take a huge amount of buying pressure for those short sellers to cover their positions if they needed to. So, yes, bearish bets exist, but maybe not a tinderbox situation.
And what about the price relative to its moving averages, key technical levels? The current price, $9.19, is almost exactly in line with its 50-day moving average, which is around $9.21, $9.22. That suggests neutral momentum short term.
Yes, basically trading flat around that short-term trend line.
But the price is significantly below its 200-day moving average, which is way up at $9.95.
Right, and that 200-day moving average is generally seen as a more significant long-term trend indicator. Being significantly below it is typically viewed as a bearish technical signal. It confirms that longer-term downtrend we've seen in the stock price and reflects the market's ongoing concerns, likely about the debt and the growth outlook, despite the short-term stability around the 50-day.
Chapter 5. Ownership structure. Okay, who actually owns Amcor stock? Institutional ownership looks very high, around 77%, and it's led by the usual suspects, the big three passive index funds. BlackRock with about 4.5%, Vanguard Group holding 6.2%, and State Street around 4.0%. What are the implications of having so much ownership concentrated in these huge index funds?
Well, on one hand, it provides a pretty stable shareholder base. These funds tend to buy and hold based on index inclusion. But on the other hand, it also means a large chunk of Amcor's stock price can be influenced by broad market flows, money moving into or out of large-cap index funds generally. Sometimes this can lead to price movements that are a bit disconnected from the company's specific fundamental performance just because the stock is part of a big index that people are buying or selling.
Interesting. Now, what about insiders, management and directors? Their ownership seems quite low, just 0.31%. But we did see a note about a flurry of activity around April 2025. Lots of acquisition, non-open market transactions listed for directors and officers. Is that a bullish signal? Insiders loading up?
This is a really important clarification. Those acquisition non-open market transactions you mentioned, they're almost certainly not insiders choosing to buy shares on the open market with their own money. It's far more likely, almost definitively, shares that were granted to former Berry Global executives and board members as part of the all-stock merger agreement, as part of their compensation or deal structure. So while it's neutral to positive in the sense that these executives now hold Amcor shares, it's definitely not the strong vote of confidence that discretionary open market purchases would represent. Don't misinterpret that activity.
Got it. So not really a signal of insider sentiment then. An ownership concentration among the top 10 institutional holders looks reasonable. No single active manager holds an overwhelming stake.
Seems reasonable, yes. It means a handful of large active managers can still potentially influence the stock price through their buying or selling, but it's not overly concentrated.
Chapter 6. Risk assessment. Okay, let's try to structure the risks and opportunities using a SWOT analysis. Strengths, weaknesses, opportunities, threats. Based on everything we've discussed from the sources, what are the key points that stand out for each category?
All right, let's break it down. For strengths, you've got their clear global market leadership, that immense scale we talked about, a strong IP portfolio with over 1,200 patents, robust free cash flow generation, and a diversified portfolio serving those stable defensive end markets. Those are the core pillars. Then the weaknesses. Most obvious one is the high financial leverage. That 2.41 debt-to-equity ratio is significant. There's also the dependence on volatile raw material prices, the somewhat sluggish organic growth before the merger, and critically, that poor track record of improving ROIC after the last big acquisition, BMIS. Okay, opportunities. The biggest one by far is the synergy potential from the Berry Global merger. That target of $650 million annually is huge if they can achieve it. There's also the growing demand for sustainable packaging solutions, potential for further expansion in emerging markets, and definite cross-selling opportunities now that they have Berry's customer base too. And finally, threats. Intense competition is always there. Increasingly strict environmental regulations like PPWR and EPR are a major factor.
There's the risk of shifts in consumer preference, maybe moving away from certain plastics faster than expected. And of course, broader macroeconomic downturns that could hit consumer spending, even in defensive sectors. So that gives us a pretty balanced view of the landscape.
Let's zoom in on a couple of those threats. Macroeconomic factors like inflation. As a big manufacturer, Amcor must be directly exposed to rising costs for raw materials, energy, transport.
Absolutely. Persistent inflation poses a direct threat. It could lead to significant margin compression if they can't fully pass on those rising costs to their customers. And if inflation stays high, it could also dampen end consumer demand for the products inside Amcor's packaging, creating a kind of double whammy, squeezed profit margins, and potentially lower sales volumes.
And interest rates seem like a particularly big risk given their debt load. Over $9.3 billion in total debt.
Yeah, that makes them acutely sensitive. A higher for longer interest rate environment directly increases their debt servicing costs. Every dollar spent on interest is a dollar less available for dividends, for share buybacks, or crucially for paying down that debt principal. So yes, the high debt makes current interest rate levels a particularly acute risk for Amcor.
And one more specific threat. Let's consider the hypothetical impact of, say, new U.S. imposed tariffs in 2025. This could mean higher costs for imported raw materials, potentially.
It could, yes. Although Amcor's global manufacturing footprint might offer a partial hedge, they might be able to source materials or produce goods in regions less affected by specific tariffs. But perhaps a more significant risk lies in the second-order effects. What if tariffs hit Amcor's customers? That could lead to reduced consumer demand for their products, which would then flow through and impact Amcor's sales volumes. Ultimately, often the greatest threat from new tariffs isn't just the direct cost increases, but the sheer uncertainty and disruption they inject into these complex, finely tuned global supply chains. That uncertainty itself can be very damaging.
Chapter 7. Conclusion. All right, we've covered a lot of ground. This deep dive really shows Amcor Pliable standing at a critical juncture. You can see clear arguments for both the bulls and the bears right now. Let's try to synthesize our key findings. So the bull case, the argument for investing in Amcor now, seems built on a few key points. First, a compelling valuation. It looks undervalued compared to its peers, and our own intrinsic value estimate suggests the stock is trading below its potential worth. Second, there's that transformative merger catalyst. The potential $650 million in annual pre-tax synergies from integrating Berry Global is a massive potential value driver. Third, attractive shareholder returns. You've got that robust and growing 5.5% dividend yield, which looks well supported by free cash flow, plus some history of share buybacks. And finally, they possess a defensive economic moat built on global scale, R&D leadership, and those sticky customer relationships in essential defensive sectors.
Okay, but then there's the bear case, the argument against investing, or at least urging caution.
This case highlights the high financial leverage that debt to equity of 2.41 significantly increases financial risk, especially with rising rates. There's massive execution risk involved in flawlessly integrating a company the size of Berry Global. And remember, their track record with the Bemis acquisition led to an ROIC decline, which doesn't inspire confidence. They've had sluggish organic growth leading up to the merger and remain exposed to cyclical downturns, even in defensive sectors. And finally, there are those long-term sustainability headwinds. If the market shifts rapidly away from plastics, parts of their massive asset base could become less valuable over time. So just to reiterate the valuation context, as of our analysis date, June 27, 2025, Amcor's share price was $9.19. And our educational DCF model, using what we believe are conservative assumptions, suggested an intrinsic value range somewhere between $10.50 and $12.50 per share.
Yeah, and this really raises that important question. Amcor Politics seem to present a pretty classic value investing scenario, doesn't it? You have this high-quality, market-leading company, but it's facing a period of significant uncertainty. The merger integration, the debt, and that uncertainty has clearly depressed its stock price relative to peers and its own potential. So you have this potentially compelling combination, a high and growing dividend yield, providing some cash return while you wait, coupled with significant potential upside if they successfully integrate Berry Global and realize those synergies. But that potential reward is definitely balanced by considerable tangible risks, particularly around the execution of the merger, the high leverage, and that concerning past ROIC performance post-M&A. So I think for investors who have a genuinely long-term time horizon, and importantly a tolerance for this specific kind of execution risk, then the current valuation below $10 may offer an attractive entry point into what is fundamentally a durable global leader right at a moment of potentially transformative change. It really comes down to your risk tolerance and belief in management's ability to execute this time.
That's a great summary. And it leaves us with a final thought to consider. Given Amcor's big strategic bet on leading in sustainable packaging, how might the rapid evolution of alternative materials, things maybe we aren't even widely using yet, how might that redefine their competitive moat over the next decade, even beyond the current focus on integrating Berry? Something interesting to mull over. And that wraps up our deep dive into Amcor. If you found this analysis insightful, please do give this video a like and subscribe to the Stock Analytics AI YouTube channel. It really helps us out. Remember, our 4.99-month members get priority deep dives on tickers. We're planning to cover all S&P 500 stocks over the coming months, and members get that exclusive priority access. Or if you just want a deep dive on one specific company, you can always request it by dropping us a super thanks. And feel free to leave your stock suggestions in the comments below. We do read them.
And just the usual reminder, this analysis was generated by an AI system purely for educational purposes. It should absolutely not be considered financial advice. Please, always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.